Well, I think there's a big shock coming for all G7 nations. They destroy their currencies. Central bankers around the world and in Asia, they're looking at this and thinking, this is actually a very dangerous situation. We've got to get out of fiat credit. And they're doing this by accumulating gold. And I think it's a process which has only just started. But you can't escape the arithmetic of a debt trap. I think the exception to this, which could well prove to be rescue, if you like, from complete monetary global annihilation, is the partnership between China and Russia. Get out of fiat, get out of credit. That's actually the message.
Welcome to the Macroscopic Podcast presented by Gold Republic. My name is Alasdair Macleod, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at Gold Republic, you will receive 1 free gram of gold. Just click on the link in the description. Today I'm joined with the one and only Alasdair Macleod, who is by now a recurring guest. Today is the 15th of July, 2025. So first of all, I would like to start with the article that you recently wrote, the couple of articles actually, about the current fiscal situation in the UK. Which you've also talked about referring to the 1976 sterling crisis when the Bank of England raised interest rates to 15% to counter a Gilt Marcus buyers strike. And can we maybe see like some parallels of that time? And do you think that we're on the cusp of another 1976 style intervention in terms of what the IMF back then did as a bailout, or are maybe other external actors at play this time?
Well, it's an extremely interesting question because in 1976, I mean, basically what happened was that sterling was entering a crisis, and there was the Americans came in and helped. I mean, obviously this was all organized behind the scenes, supported sterling. Sterling recovered. But then they put in the bank manager. And of course, the bank manager is the IMF. So, and the interesting thing is that the chancellor of the time, Dennis Healey, was due to fly to New York for an IMF meeting. This was a general IMF meeting. And he was sitting in the, if you like, in the VIP lounge of at Heathrow Airport, having a gin and tonic. And he was told, there's a problem. We've got to go back. So, that was his trip to New York was cancelled, and he went back. In fact, what the IMF did was they had a series of secret meetings in Brown's Hotel, which is in the middle of London in Mayfair, which wasn't meant to be known to anyone, but it was leaked to the press. And then the thing started kicking off. And basically, the IMF forced the British government into welfare cuts in public spending, all the sort of they were crazy left wing, just as they are today, literally. It's doppelganger, if you like, for what was happening today. Left wing cabinet ministers like Michael Foot decided they couldn't go along with this, so he resigned. So he went off into the wilderness, forever to be forgotten. The medicine which the IMF forced us to take actually retrieved the situation. But part of that was that, already interest rates had risen quite high. We had also had a crisis before then. 1973, late 1973, the Bank of England raised interest rates because of a buyer's strike. This was not, the 76 was an ongoing problem, if you like, in that sense. And when they raised interest rates in, I think it was late October 1973, that triggered what became known as the secondary banking crisis. Now, secondary banks, basically in those days, you didn't need to have a license to operate a bank. You just had to have the credibility behind you, if you like, as with any bank, a bit of capital, and so on. But these banks were almost exclusively involved in lending for commercial property development, and particularly office property development. There was a lot of speculation in it at the time. The increase in interest rates just collapsed the whole bubble. And I remember as a stockbroker on the floor of the house seeing the whole of the property sector. We had all these stocks, and you had a jobber's board, and a jobber would specialize, say, in property stocks. And you had, I think, three firms of jobbers specializing in. And the markdowns, the sector was just wiped out, literally, in the space of a week. It was disastrous. It really was. This time, I suppose you could say that we had a little bit of a problem when Liz Truss got elected and tried to sort of, rather than do the impossible thing, cut welfare payments, thought she would try and stimulate the economy by cutting taxes. And that pushed bond yields up and so on. So I suppose that's a sort of similar situation, but it's not quite. We have the same situation today, but the difference is, can the IMF come in and rescue us? I would suggest that the IMF, if it was free to act and had the power to act, would actually go and tell Donald Trump, look, come on, you got to cut your spending. But, the problem is that the Americans own the bank manager. So the bank manager isn't going to turn around and tell the Americans what to do. So you can see that it's not just the UK this time. It's general. Virtually all the G7 are in the same problem. But the standout ones, if you like, in the sense of escalating welfare costs and the wrong side of the Laffer curve when it comes to getting tax revenue in, because they've already pushed tax revenues up. And it's now becoming self-defeating, in effect, in terms of revenue enhancement. You've got Britain, obviously, the UK, France, Spain, perhaps Italy. But with Maloney in charge, I think there is a sort of slightly more realistic approach to life there. Germany, they don't have quite the same debt to GDP problem, but they're going that way, with the new government. So that's not good. America has a slightly different problem. They've got, a president who is just completely out of control. So, his new wonderful spending bill, his tariffs actually haven't, they've produced a bit of revenue, like $500 million or something, but that's not the answer that Trump thought it would be. We'll replace all these income taxes and corporation taxes with tariffs. No way. That debt is now completely out of control because part of the problem is the president is out of control. So it's really 1976. We've got the same problem again in the UK, but also there are wider lessons, I think, for other G7 members.
Yes, so basically the fiscal plan that's been also put forward, and then maybe I would like to dive into that more specifically for the UK to understand a bit really the root causes of that problem, is that the Chancellor, Rachel Reeves, since a year has put in place a plan to change a bit the way the fiscal situation in the UK looks like. But with today, like if we look back a year later, how would you paint that picture? What are the policies that have been undertaken, and what are the actual consequences of those policies?
The first thing that Rachel Reeves did, I think, was to try and satisfy Labour Party's backers, the trade unions and so on and so forth. So what she did was she enhanced the cost of government by giving pay awards, particularly to National Health Service workers, bureaucrats, all sort of catching up, if you like. You can see the argument, and also not at that stage part of government, but railway workers, and of course the other promise is to renationalise the railways. So she incurred a lot of extra expenses in terms of government. Now, the other thing she did was obviously, the socialists think, well, the rich can pay for it. And so she started increasing taxes, like doing away with non-doms. She basically made it a lot more expensive for any wealth creator to stay in Britain. And so we've had an exodus of people who have gone to other centres like Dubai, Italy. I mean, I tell you what, you can live on Lake Como and commute into Milan and actually have a lovely lifestyle and all the rest of it. And, Maloney is, perfectly prepared to let you stay there and not be taxed on your worldwide earnings for a lump sum of, I think, 100,000 euros a year or something, which, if you're a multi-millionaire or a billionaire, makes an awful lot of sense. And I think the head of Goldman Sachs in Europe has gone from London to Milan as a result. So the point about it is that we've got a very unbalanced tax system. The top 1% of earners pay 30% of all income tax. So we can't afford, from a fiscal point of view, to lose these people, but that's what's happened. She's also done other things which are really pure socialist. I mean, the sort of socialists in town, as it were, or in London, who actually have absolutely no concept of country affairs, agriculture, and things like that. They view, the farming community as the people who go out hunting foxes and killing them and shooting and doing all these sort of things. But the vast bulk of farmers actually, are really struggling. I mean, they always struggle. What she did was she turned around and said, right, okay, we're going to remove the inheritance tax concession, because the only way farmland can be passed from father to son, or father to daughter, whatever, and go down the generations, is so long as there is no inheritance tax on that land, because there are not the margins in the business to finance any tax take, on succession. So anyways, she has introduced that. She also introduced, so that's really upset a hell of a lot of people, and will backfire. There's no doubt about that in terms of food production. And the other thing she did was she decided to introduce VAT on public schools. Now, just for an international audience, to get around any confusion, a public school is in the private sector. Okay. The state system is the government public sector, if you like. So, when we say public schools, what we mean is private schools. And introducing VAT, which means that they can no longer have the benefits of charitable status, which most schools are. I mean, they just reinvest everything into into providing better education facilities and all the rest of it. And they run themselves generally pretty well. But they run as charities. Anyway, they've had the VAT concession on charities removed, which is, from a socialist idealist standpoint, one can understand that is, if you like, in that we want to destroy the bourgeoisie. Okay. But from a revenue point of view, it's the most stupid thing to do, because it's meant that quite a lot of schools are having to close down, and the pupils are coming out of that and they're having to go into the state system, which is considerably more expensive per pupil than any private system, which costs the taxpayer absolutely nothing. So, she's done a lot of things to increase expenses of government very substantially. And this is now backfiring. And the point about the article, which you referred to earlier, that I wrote, is that I think that the information that's coming in from HMRC, His Majesty's Revenue and Customs, which is a department of the Treasury, is that the tax take is not, it's less than expected. And I think this is creating a bit of a crisis, if you like, in terms of Treasury policy. So, the way I put it was because she was crying in Parliament, and I think it's literally the whole thing just getting on top of her. Anyway, she's actually got a speech in Mansion House this evening. So they're now talking about introducing wealth taxes and so on. In other words, when they're in a hole and they're just digging deeper. Why? Because they cannot cut welfare costs. Welfare costs are spiraling out of control. It's not in the socialist playbook to cut welfare costs. Labour MPs are elected to enhance welfare, not cut it. And so there was parliamentary rebellion. So they've ended up not being able to cut any welfare expenses at all. So you can see that this is a situation which is leading into that 1976 doppelganger of a crisis. I personally expect to see bond yields rising further because the risk associated with sterling bonds, gilts, I think is underestimated by foreign holders. And we have got a lot of gilts in foreign ownership at the moment. I don't know what the proportion is, but it's well over 30 or 40%. I mean, it's at least as bad as the situation the US Treasury is in, and probably worse. And I expect sterling to fall. At some stage, I think like a stone, probably at the time of the autumn statement. I don't know what the date of the autumn statement is, but we've got a lead on this perhaps with the Mansion House speech tonight, which is traditionally a point in the city where the Chancellor, sort of, if you like, indicates a slight way forward and hopefully reassures the attendees from the city that she's actually, quite sensible. Good luck with that one. But she's got herself into an impossible position. Why? Because when she was appointed Chancellor, Labour was elected, Socialists were elected, she pursued, payback time and far left socialist spending. And it's gone back to bite her. And as I say, when it comes to the Laffer curve, which socialists don't believe in, they deny it completely. Oh, this is just a load of nonsense. But, there does come a point where, you start increasing the rates of taxation, people just adjust their behavior like they flee the country. And then, your tax revenues go down. And that's where we are. We've got declining tax revenues. Oh, and the other thing I would put on top of that is that what she has done also with what we call, employer's stamp, which is like if you like, a tax on employment. She didn't actually increase it on the employees, but she increased it on businesses. And the result is that unemployment is now rising. Of that, there is absolutely no doubt. It's driving the country into recession. I think the world is sort of either going into recession on the brink of it. Don't believe the government statistics. They are complete rubbish on this. I mean, just go around and look around you and see what's going on. So that's another reason that the tax takes are going down very substantially. I mean, one of the things is the property market. Oh, yeah, she, in effect, increased stamp duty, which is a turnover tax on property. And, by, stopping previous reliefs, which were temporary. And what's happened, the whole of the property market has just seized up. Partly because in London, all the people who can pay 10, 15 million for properties are gone or going. And around the country, people don't want to pay a 5% stamp duty. The cost of moving is just absolutely enormous. So we're all sitting in our houses. We might have sort of decided that we would like to buy another house, or renovate our houses or whatever. And the costs have just gone up and up and up and up. Nobody's doing it. And inflation is considerably more than the official statistics say, and they are rising. I mean, I wrote an article yesterday looking at the prospects, if you like, for base metal prices. I mean, they're going to be rising. And I think people are going to be very surprised how sharply they're going to rise. Not helped by Trump turning around, for example, and saying, 50% tariff on copper. You know, he's killing his own industries. I mean, the lunacy of the situation that he gets himself into is just absolutely beyond description.
So on one side, there is this big desire of trying to keep up with the spending that governments are very good at, just spending, where bond markets are trying to keep them in check. But that balance is actually veering off. It is becoming unstable. It's kind of a house of cards that shows the first signs of collapse. How do you see this now, more particularly in terms of the European landscape? What are the next steps? The William White interview that I sent you, that you thankfully posted on your own Substack, was saying that we're entering a huge era of not only fiscal dominance, but financial repression. How would you describe this?
I think Bill White was right to be concerned about that. The way I see it is, well, I think there's a big shock coming. Everybody expects interest rates to fall. They're not going to. Why? Because they don't understand actually what interest rates represent. Interest rates represent, in the main, if you like, compensation for the risk of parting with money or credit in favor of someone else. In other words, if someone's going to become your debtor, you've got to make an assessment. What compensation are you going to get, if you like, to make it worthwhile you lending credit to someone else? And it doesn't matter whether this is interest rates or bond yields, but if you see increasing risk, then obviously you're going to demand a higher return, a higher interest rate, if you like, or bond yield. And that's actually what we face. Yes, if you go into the stock markets, gilt markets, whatever, and you talk to people, they're sort of saying, we expect a cut in interest rates later on this year. I mean, it started off with, in the US, for example, people saying, we think there are going to be 4 interest rate cuts this year from the Fed. Now they're down to 2. No, it's not going to happen. It can't happen. For the very simple reason that if you're going to cut the return which you're offering foreigners, and indeed your own institutions, to fund government debt, then they're not going to play ball. And so this is why we have seen there's virtually no demand other than mandated demand, for example, from pension funds and maybe certain elements of the insurance company for long-term debt. I mean, all they're doing is they're trying to match long-term liabilities with long-term credit, the form of bonds. So that basically, the long end of everything is basically just shut down, and we can already see again the long end of the JGB market yields are beginning to rise. Also, German Bund yields are beginning to rise again. I think they're leading the way this time, but the casualties in this are likely to be the US and the UK, the Anglo-Saxons. They've got no savings at all. This is the problem. They just don't save, unlike the Germans. So if the Germans and the Japanese, who are basically savings-driven economies, find that their bond yields are beginning to rise, I think that's a very, very important indication of the trouble ahead. Now, the Fed understands this, and so does the US Treasury, because of their experience with auctions. There's been very little appetite for longer-term debt. So what they're doing is they're saying, right, we're going to reduce the supplementary leverage ratio on big banks, which will free up credits, which they can then rush out and buy US Treasuries with. But banks are not going to buy duration. They will buy 3 and 6 month T-bills. I mean, no bank in their right minds are going to go up much beyond that. That is for sure. But this has a problem, which or it gives rise to a problem, which I think is being shared by all nations, and that is that the maturity profile of their debt pile is getting shorter and shorter and shorter, which means every year more and more and more of it's got to be rolled over. But you can't escape the arithmetic of a debt trap. You have this problem that when the growth of debt is faster than the ability to pay for it, then you're in a debt trap. So the only answer to this is higher bond yields. But higher bond yields make the position worse. So you need yet higher bond yields. And going back to 1976, this is when we saw 3 gilts with coupons of 15 and a quarter, and 15.5% issued for a government desperate to borrow money in the markets, both domestically and internationally. We're going to get the same thing in virtually every other major jurisdiction. I think we'll see it. We'll see it in dollars, we'll see it in yen, and we'll also see it in euros. Certainly see it in sterling. I mean, this is the only discipline now on markets is not calling in the IMF, and the IMF, rather like they did with Greece as well, more recently than with the UK, saying, right, you've got to do this. The only discipline is market. And of course, that leads to a crisis. What happens when bond yields rise? Well, it's not just governments, but also you got all the zombie businesses, the legacy of debt, excessive debt creation in the past, made far, far worse by the COVID problem, and the belief that interest rates were never going to rise again, which did for a lot of the regional banks in America. There's no doubt in my mind that there is going to be a real crisis. And then the problem will be, what does the Fed and the US Treasury do? Do they abandon the support for their currency of trying to keep interest rates up to the point where nobody actually sells it? Do they abandon that in the interests of rescuing the zombies and themselves? Well, if they do that, they destroy their currencies. And I think this is what we're seeing. I mean, the central bankers around the world and in Asia, they're not part of our system. They're looking at this and thinking, this is actually a very dangerous situation. We've got to get out of fiat credit. And they're doing this by accumulating gold. And I think it's a process which has only just started. Get out of fiat, get out of credit. That's actually the message.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at Gold Republic. At Gold Republic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at Gold Republic, we offer real assets to safeguard your generational wealth. And also that ties back to what you've just written yesterday, is that historically you've demonstrated that there's an inverse relationship between gold and base metals. And now that we've seen higher prices for silver, just $37 an ounce just a few hours ago or yesterday. Copper, same thing. There was also reaching new highs. There was already structurally the case, if you look at the way the chart looked, it was already set up to go higher highs, but the tariffs that Trump put in place obviously accelerate that. And obviously the skyrocketing price growth of platinum have also risen even in gold terms. So is this a market's way of pricing the failure of fiat in that sense?
Well, there are two elements of this, Alex. One is, as you say, it's the sort of market, if you like, adjusting. But I think the other thing is that there has been a lot of suppression of metals prices by virtue of the fact that the dollar has been debased. That the dollar is the principal currency. All the other currencies go with it, but the dollar has been debased so much that they've also taken down the value of base metals. But my starting point in trying to explain this is that we know that over long periods of time, the purchasing power of gold is relatively constant. Now, obviously, individual commodities, some will rise and some will fall. There will be differences, if you like, because of in demand and also supply, new mines and mines being exhausted and, fashion, or if you like, new technology moving on into other materials. So you'll get all this sort of evolution, if you like, going on. But if you take a sort of a basket of base metals, then quite obviously there is a level where those base metals will be priced in gold relatively constantly over time. Now, there can be some variation of that. I mean, in wars, for example, and also in the 1950s, when there were some significant strains, 50s and early 60s, there were some significant strains as the dollar, was being expanded. Dollar credit was expanding very, very rapidly. Yet it was stuck on a gold standard at $35. The result of this was that prices rose, but because you had that $35 relationship with gold, between the dollar and gold, it meant that as prices rose in dollars, it was taking prices up in gold as well. And so we got to a point where prices have risen by roughly 150% on two occasions. The third occasion when this happened was in 1970, and that led to the breakdown of the Bretton Woods system. I mean, this is, if you like, one of the things that you see, if you like, in when the system is under strain. Now, what's happened, of course, is that with the purchasing power of the dollar falling and falling and falling since the end of the Bretton Woods, we now have a situation where the purchasing power of the dollar has gone down, which means that the price of precious metals has risen, but they have not risen enough to reflect the fall in purchasing power of dollars. What we have as a consequence is we have, if you like, take the 1900 price, which actually held pretty much all the way through to the early 1930s for an index of base metals. That has now fallen by something like 77% from that 1990 level measured in gold. We go back to the long-term purchasing power of gold being constant. Now, this tells us that it's not gold, if you like, that is too high. It's base metals which are too low, measured in gold. They will recover measured in gold, and they've got the potential to increase by some 400% in gold alone. Now, what does that mean in dollars, fiat dollars? It means that the increase in fiat dollars is likely to be considerably greater than 400% for an index incorporating a wide range of base metals. So commonly we think in terms of inflation rather than the debasement or the loss of purchasing power of the currency. But what it means is that we've got huge drivers of inflation in the background, which are just beginning maybe to come through. And of course, the Keynesians find that this is something they just don't understand, because they just think in terms of supply and demand. They don't think of in terms of any variation of the purchasing power of a currency, other than maybe modified by the retail price index or the consumer price index or whatever. And consequently, they think that, and having got rid of Say's law, which is what Keynes did back in 1936, they think that if you get a fall in demand, then that means that commodity prices are going to go down. They will get a horrible shock when they find that commodity prices start rising as our economies go into recession or slump. That, I'm afraid, is the outlook. And it's an outlook made far worse by the risk that we see for fiat currencies as foreigners and increasingly domestic institutions begin to latch on to what actually drives interest rates, and that is the risk of an investment and the currency it's denominated in. And they see those risks rising. This is not going to be good. So that, I'm afraid, is the outlook. And it's very good for gold in the sense that gold prices will appear to rise and rise and rise. But of course, it's not so much gold rising, it's the value of what you measure it in collapsing. And I think that we're seeing this beginning to accelerate. And this has become a lot more obvious in recent days. And I don't know about what you're finding, Alex, but I find a lot of media, for example, a lot of people that I've talked to are beginning to see that these are problems in the future. They're beginning to wake up. They haven't fully woken up at all by any means, but you can see that there's a sort of big question marks over the future. In aggregate, I think what markets are doing is saying, we just can't analyze this, so we're not going to do anything. So you're seeing equities, which are at the top of the the largest bubble in history. And I would argue this is greater than anything we've seen before, even tulipomania, even South Sea bubble, even the Mississippi bubble, even 1929. Far larger than anything that we've seen in history in terms of credit. This is extremely dangerous. And I think that the collapse that we're likely to see in equity values, the rise in bond yields, so the fall in bonds, the bankruptcies and all the rest of it, it's all there. And there's nothing anyone can do to stop it. There's no political mandate to even address it. We have governments, who sort of, they are completely unaware of the debt situation. Or if they are aware of it, they daren't even mention it in public. It's verboten. This is I think, a very dangerous time. Very, very dangerous time for all G7 nations. I think the exception in this, which could well prove to be our rescue, if you like, from complete monetary global annihilation, is the partnership between China and Russia and their assembling of Shanghai Cooperation Organization and also BRICS, because more than half the world's population are now, if you like, out of our sphere of influence, trying hard not to upset us, because we've still got a lot of power to go back and hit them. But at least half the world will be going on while we try and sort ourselves out. Thank goodness for that.
It's indeed, as you mentioned earlier, I think slowly there are more and more actors, experts, people that are involved in financial markets and beyond that are starting to wake up to this. Maybe, and I want to come back to the metals part, because you've been mentioning that it's been suppressed for so long. It means that it needs to revert to its mean in one way or another. And in particular, I would like to maybe zoom in into silver and into the gold-silver ratio. How do you see now, like with the sudden rise that we've seen in silver in the past days? Do you see this now as a confirmed trend towards a lower gold-silver ratio? Where do you see silver surging now? Is this now a structural uptrend that is fundamentally ultra bullish? How do you describe this?
Well, the interesting thing, if you're looking at this sort of gold and base metals relationship, is that the metals that are leading the way out of this severe undervaluation are what we would term precious metals. I wouldn't actually call them monetary in this sense, because monetary metal, actually, the only monetary metal being priced as money is gold. I mean, the others are priced on an industrial basis. But it is those, it's rather like sort of having precious and semi-precious, if you like. It's the semi-precious which are beginning to lead, the others out of some sort of trough. And amongst those which perform so well, you've got obviously platinum group metals, palladium and platinum. I guess rhodium, though I haven't been following that one. They're not easy to find prices for that. Also, interestingly, as an alternative, I know it's not a metal, Bitcoin. That suddenly sort of really perked up again. And copper, Dr. Copper. That silver and copper are two of the most useful industrial metals there are. They're not being priced at all as monetary metals, though there is a history of both silver and copper being used in coinage as a form of money. So, but I think that's sort of coincidence. It's just interesting that they're beginning to lead the whole of the metals complex, I think, out of this very, very severe undervaluation. So your question about the gold-silver ratio, I think we're going to see it fall further. I think we'll see it fall quite significantly. I mean, I wouldn't rule out at all. In fact, I would expect it to move back down to around about 50, which has been some sort of average over, really since about 1900, I suppose, or the 1880s. Because it was in the 1870s when silver was no longer, the silver standards, if you like, no longer applied in Europe. The last one being Germany, which went on to a gold standard, I think, in 1873, thereabouts. That meant that the value of silver was then being priced for its next use. And so the gold-silver ratio from that point rose from 15, 16, whatever, on the way up. And of course, it peaked under President Trump in his first term in office at something like 120, and is now on its way back down again. And this is particularly important because if I'm right about the relationship between gold and precious metals, then we are going to see silver recover very substantially, and not the only one, even measured in gold. Of course, everybody concentrates on silver because that is if you like, the second most important monetary metal in the absence of fiat currencies. So, you get loads and loads of bulls, if you like. So, pessimists like me thinking, that if we're going to have a currency crisis, or it's the end of the fiat currency era, then silver's going to come back. I think that will probably fuel some speculation, but I think the main point which everybody is missing is that it's not just silver, but it is all the other base metals which have been suppressed by the fall in the purchasing power of fiat currencies. So much so, they can even quadruple against gold just to return to normality. And what does that mean if gold continues to rise against the dollar? In other words, the dollar continues to fall, pushing gold dollar values even higher. Well, it means that when it comes to inflation inputs, if you want to look at it in more conventional economic terms, those inflation inputs are going to be very destructive of fiat currencies, horribly so. That's the future, I'm afraid. And what does that mean for bond yields? Oh, up, 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 up. And it's got nothing to do with the collapse in economic activity that will happen. That's going to happen. That's going to happen, partly because of the adjustment, but also because of the past history of suppressing interest rates and the accumulation of unproductive debt.
So the gold price, the gold-silver ratio increasing, so gold seeing a rise in itself compared to the dollar, and then the gold-silver ratio declining, so that really means a stratospheric rise in terms of silver in that case.
The fascinating thing is I know so many people, in sort of metals industry, whatever, and they all look at it. They all look at these commodities on a supply and demand basis. Not one of them, to my knowledge, actually looks at it from the point of view of the changing faith in a fiat currency and how that affects prices. Copper is a classic, okay. I mean, the big consumer of copper is China. So what happens in the Chinese economy is fundamental to the price of copper. Yeah. So, if the Chinese economy is going down, then as an analyst, I turn around and say, I'm being conventional, this isn't me. As an analyst, I would say, demand is going down, supply is going to continue, therefore, the price of copper has got downside. It's going to go down. But they're missing the most important thing, of course, which is against what? Okay, in real terms, but it's already it's already suppressed in gold terms, which are real terms. And then when you put an overlay of a devaluing, debasing fiat currencies on top of that, then measured in those, it's going to, this is a disaster. It really is.
And why do you think it's been suppressed then for so long?
It's a function really of the fiat currency regime that really has been in place ever since 1933-34, when gold, in early 1934, the dollar was devalued by 40%. In other words, the gold exchange rate was raised to $35 from 20.67. That sort of held all the way through to 1971, when finally the expansion of the monetary base, if you like, the expansion of unproductive dollar debt really meant that the relationship at $35 became virtually impossible to maintain. I mean, and bear in mind also that the Americans had reduced their holdings of gold from 1947, 48, from I think something like 21,000 tons, 22,000 tons, down to 9,000 tons in 1971, when finally they threw in the towel on the gold standard, or what sort of passed for a gold standard. And since then, we've had a fiat currency. It started off with the US Treasury going on a propaganda campaign saying, gold is no longer the, if you like, the standard. We went from a fixed exchange rate regime to a floating exchange rate regime. The dollar was the king currency, okay, and it sort of got to the point where this rubbish, this propaganda was so believed that they were even describing gold as a pet rock. It's no longer part of the system. But the interesting thing is that now nobody's talking about gold at all. We just don't want to talk about it. We don't want to talk about it. But as I say, I mean, you can go back to the Emperor Diocletian, who introduced an edict of maximum prices It was around about 270 odd or 300 AD. I mean, a long time ago, 1700 years ago plus. And you can look at those prices. Okay, the slave markets no longer operate, so there's no comparison there. But you look at things like, beer, wine, clothes, all these things, they're similar price today, measured in gold. The thing that's changed, of course, is that currencies come and go. And every one that comes goes. Because what's currency is credit. And eventually, the credit becomes worthless, or it becomes questioned, and it has to die. That's what happens. Governments, and the Americans have been no different at all from all governments in history. Basically, what they've done is they have printed, they have expanded credit unproductively to finance whatever the politicians want, or whatever the people demand of their politicians, to the point where they destroy their own currencies. And that's where we've got to. It's exactly where we've got to. It's the end of the fiat currency regime looming. How long it'll take, I don't know. I mean, it could be anything from a sudden nasty shock later on this year, or it could take another 2 or 3 years.
And what's all the more surprising as well, and you mentioned Bitcoin, but we've seen all those rises, also the S&P reaching new highs, but we're still at those very high interest rates. And the fact that Powell also has more of a political almost motive than a monetary motive to not cut rates lower, because of, on top, having Trump pressuring him and markets soaring higher. What would it be if actually Powell would start cutting rates even more? Is that most probably, and you tell me if you think that's the case, we might see even higher prices across the board.
Yeah, well, Powell is absolutely right not to cut rates. And I suspect Scott Bessent also understands this. The problem is the president, who is just either doesn't listen or is just completely deaf to reason. I think the president realizes that he's got problems, but he thinks the solution, and he's a real estate man. The solution is cut interest rates. Also, real estate values go up when you've got inflation, like prices rising. Okay, let's cut get a lower dollar. That'll push up. Yeah. It beggars belief, really. If Powell is forced out, then that will push the dollar down very substantially. It really will. Because anyone who's going to replace him, initially anyway, is going to be, if you like, Trump's patsy. And then, I'm sorry, it's good night nurse. I mean, it really is. It's just crazy. And Powell, he's no fool. He may be pursuing the wrong policies, but then that's the mandate he's got to work with. But he's no fool. He realizes this. And markets realize that, if he gets forced out, then, it's good night nurse. It really is. I suspect Scott Bessent also knows this, because he seems to me to be a relatively sensible person. I mean, he's done quite a few somersaults, if you like, having discovered the reality of being Treasury Secretary. We no longer hear about, we've got to go and have a look at those damn gold reserves in Fort Knox and make sure they're really there. We don't get any of that anymore. No, don't say anything. Just no, nothing. We don't want to hear anything. Just don't say anything. And that's what we're getting on the gold, on the gold reserves front. So, I can tell you that if Trump gets his way on Powell, and Powell, I think, is actually behaving very responsibly in this. He's not rising to the bait. He's not saying anything at all. He's not creating any waves himself. It's just the president being an idiot. And Powell, meanwhile, is going on with his job. And he's very, very sensible to do that. And I'm sure also that other central bankers around the world are watching this, and we saw almost disbelief and rather hoping that that Powell actually manages to continue for the rest of his term.
But how do you explain then, because we talk about precious metals and commodities rising, and then on the other side, there would be, let's say, equities and Bitcoin. What motivates the rise on that front?
On Bitcoin, it's pure
on
speculation.
Bitcoin now, more specifically.
Yeah, well, it's speculation. I mean, if you look at it correlates beautifully with the NASDAQ. It's the same bunch of players pushing Bitcoin. Also, there's something sort of akin to a Ponzi scheme going on. There's a company called MicroStrategy who basically, they're running the sort of something which is akin to, it's sort of, I don't know, it's just sort of promotion, and the idea that you can subscribe to a preference share in MicroStrategy, which will be convertible into ordinary shares at a later date. What happens is that you're effectively, financing the buying of Bitcoin today for the benefit of the existing shareholders, and particularly the founding shareholders. And you will be converted from, sort of, if you like, a fixed interest into ordinary shares when at a later date. If you really believe in Bitcoin, then just go and buy the damn things. This scheme is the sort of thing we see at the top of every credit bubble. And it's the most egregious of all the schemes I have seen and read about, going all the way back through Dotcoms, through particularly the South Sea bubble. I mean, you had less of this corporate activity at the time of the Mississippi bubble in France, but it's that. If Charles Mackay, who wrote his famous book about bubbles and the human psychology and behavior, and if he was alive today, he would be rejoicing in this extra chapter. That's all it is. And if you don't believe this is a credit bubble, which very few people actually really understand, look at the other side of it, because for every credit there is a debt. Is there a debt bubble? Ask yourself that.
Clear. Thank you, Alasdair. I think we've covered a lot of topics. Is there maybe something on the COMEX front that you want to give an update on, where you think in the paper markets there's still like some interesting signals in terms of the physical delivery that we've seen in silver and gold, for example?
Yeah. When you look at the paper markets, of course, we really don't have all the information to be able to put all the pieces together. But I think what happened earlier this year is it raises some very, very important questions. We had suddenly, out of nowhere, huge premiums on gold and silver contracts on COMEX. And this encouraged a flood of bullion out of other centers into America. Now, the trigger for this was probably, and I think this is true, the fear that President Trump was going to have a blanket 25% tariff on all imports, including gold and silver. I would have dismissed that personally, but you could see from the point of view of American operators on COMEX that this was a problem. Why is it a problem? Well, the problem basically is they had stand for delivery obligations which were continuing at pace. I mean, it's just remarkable that this market, which has a stand for delivery option, in order to tie the expiring value of a contract with bullion, so that the whole thing is tied to bullion, if you like, the whole of the sort of series of contracts are all tied to bullion. It was never intended that this is a means whereby people would go in and acquire bullion. The fact that they're going in there and they're acquiring bullion in huge quantities tells us that there's something very, very far wrong And that far wrong is that there is not enough supply of bullion around the world for people to really get the bullion they need. Now, we don't know who these stand for delivery are, but they're not the hedge funds in the managed money category. That we can be pretty certain, because hedge funds just have leverage plays, sell dollar, buy gold, sell gold, buy dollar. That's, there's twin trade, pairs trading, if you like. These are in the, the others categories, the two others categories. Now, if you look at stands for delivery between 2021 and 2024, it's 2,100 tons. This is a very significant amount. If, on the other hand, you look at it from the beginning of this year to date, the annual rate of the stand for deliveries is roughly running close to 1,500 tons. In other words, we've gone from 2,100 over 4 years to perhaps 3,000 tons this year. No, not 3,000, sorry, 2,000 tons this year. Or, sort of 1,500 tons this year, 1,500 to 1,000. So in other words, the pace of the stands for deliveries has increased very, very substantially. Now, if you're operating on COMEX, you understand that you've got these obligations. There will be undelivered obligations, perhaps, insofar as, they haven't gone off your books. You just sort of promised to deliver it and, delayed, maybe. Which apparently is a feature. And also in the case of silver, in particular, the ownership of stands for delivery silver, that's still remaining mainly in the COMEX warehouses. And I guess the reason for that is that when it comes to using silver, you'll take it out as you need it. You don't necessarily think, I need to actually possess this, which you would with gold. So that, I think, is what it's about. But this has created a problem because in order to take the arbitrage created by the premiums on COMEX, let's say a London operator has to take gold out of London, ship it over to New York, and then at some stage, they've got to reverse the transaction, particularly if they've leased that gold. And that gold's got to be restored to whoever leased it to the bullion bank in the first place. Now, the lessors rather, are in the main central banks who've stored their gold in London, and possibly, maybe to a lesser extent in Paris, maybe, Switzerland as well. But basically, we saw the rush, if you like, of gold being taken out of the Bank of England, which confirms to me that a lot of that gold was leased gold and therefore temporarily the property of, say, a bullion bank or a large fund, sort of dealing in gold and taking advantage of the arbitrage opportunity. I've got to get it back. What do the central banks in this think? They must think, hold on a minute. It's all very well earning a few pounds or dollars or euros, if you like, on leasing fees in order to pay the storage costs. But if we don't get our stuff back, our property back at the lease expiry, then we have a problem. And I think that this is the problem. We've seen one side of the transaction of the arbitrage. We haven't seen the other side yet. And that, I think, is going to, it could close down the derivatives markets. And if that happens, you've got to bear in mind that the counterparties in the precious metals derivative markets are also counterparties in other derivative markets. So the whole of this derivative thing, we could start to see unwinding. And that is a very, very serious issue.
When we look at what the Fort Knox and the Fed, the New York Fed vault audit haven't been done since the 70s, proper audits. And that I've talked with my friend Willem Middelkoop a few weeks back, and he was telling me, he also published a whole article about why he thinks that this whole thing is a mirage, it's a facade. When you look at the pictures, when you look at the way the gold bars are stacked up on each other, the fact that what you've also mentioned in our last interview is that the Germans wanted to retrieve their gold, and they've been told, oh, no, you have to wait at least 7 years for this, is that all this dynamics that we see in the paper market and the need for also physical gold is maybe, and this is where I would say in journalistic terms it might be speculation because it's not factually based, but maybe entertaining to think that indeed there might not be as much or much less gold reserves held by the US in Fort Knox and the New York Fed.
Yeah, I mean, as you say, we don't know the answer. We can only go on circumstantial evidence. But there was also some pretty convincing evidence put together by an analyst called Frank Veneroso in the last century, in the run-up to 2000, which he presented in a speech which he made at a conference in Lima in 2002 about the level of leased gold, which was the basis of the carry trade into US T-bills. I mean, basically US T-bills in the early 1980s were yielding over 10%. So what you could do is you could lease gold at 1%, sell it, and take the dollars that you've gained and invest it in T-bills. And you got, and if you leverage it up, I mean, you're making loads of dosh. But of course, the other side of the transaction is how do you get your bullion back? Well, nobody really worried too much because gold was in a bear market due to the very high interest rates which Volcker brought in 1980, 1981. And, it was a long-term declining trend. So nobody was terribly worried about this. But as Frank Veneroso said, presumably this gold is now adorning the necks of Asian women. Now, I think there is another side to that story. And that is that I think the Chinese, particularly after 1983, were quietly accumulating gold reserves as a result of the opening up of their economy with the West. But that gold has effectively never been returned. And Veneroso's estimate was that somewhere between a third and a half of all central bank reserves were out on lease, perhaps never to be returned. And that was in 2002. And of course, since then, we've got this new problem on top. I mean, so we've got this situation really where gold has sort of disappeared, if you like, from central banks. Now, there are some central banks who are building their reserves, but these are not the same ones who were leasing it back, sort of 30 years ago. But it does sort of raise the question, what have the Americans got? I mean, they were leading the way in terms of suppressing gold. So what have they got left? And in their suppression, have they taken not only their own gold out of Fort Knox and elsewhere, but have they also raided custodial gold, earmarked gold, held on behalf of other central banks at the New York Fed? We don't know, but the circumstantial evidence suggests yes, they did. And that circumstantial evidence was their refusal to let the Germans, the Bundesbank, inspect their property, and their refusal to return it except over a long period of time. Now, where they managed to steal the difference, because they realized that this was actually creating a lot of bad waves for them, where they managed to get the difference to get the Netherlands gold back in more or less one deal. I don't know. They probably robbed it off someone else. But you can see that there's a lot of missing stuff. Well, there are lots of big questions unanswered. And of course, I think it was Warren Buffett who liked to say that, when the tide goes out, you'll see who's wearing shorts. That's what we're now facing. I mean, the end of the fiat currency system is going to expose an awful lot of stuff, which very few people suspect.
Thanks, Alasdair. On that note, I think it closes off our interview on a great note, and that leaves our viewers ponder a bit about that question, hopefully also protecting themselves around this scenario. Alasdair, you have a newsletter, as many people know, so I'd like to remind that the viewers and listeners who are not familiar that you have a newsletter, Macleod Finance, on Substack, and you are obviously regularly contributing to your Twitter profile. Thanks a lot, Alasdair. It's been a pleasure as always.
It's my pleasure, Alex. Thank you.